Anyway, hey, thanks everyone for coming out. Always really, really appreciate it. Just for anyone new, I'm the portfolio manager of the Global Value Fund, Miles Stoudy. With me, I have the lovely Emma Davidson, who's the head of corporate affairs for Global Value Fund and is also the CEO of Stoudy Capital, which means she gets to boss me around at work and at home, which is great.
Doesn't listen though.
We're a listed investment company on the ASX. I'll let Emma give a little introduction to who we are and what we've been up to. And then to the best I can, I'm going to say a few words about the big picture, to try and give some insights into what's going on. And if you can bear with us till the end, I have I think, a really interesting case study to talk about. But I'll keep you all hanging on that.
I think it's interesting too. So you're not alone. Okay. Actually, do we have anyone new today?
Chaps from Orange?
Oh, yes. Hi, guys. Okay, yeah. All right. Okay, so what I'll do is I'll just start off with a quick reminder of who we are and just a quick refresh. The Global Value Fund is a differentiated strategy. You know, we're not stock pickers. Instead, our core skill set is this ability to kind of go around the world looking for essentially assets that are trading at a distressed level, or a discount is what we like to call it. And then what we do is, using a variety of hands-on techniques, we look to extract the discount from those discounted assets that we've purchased. One of the most easily recognizable of those tools would be shareholder activism, for example. But there's many other ways that we do it, corporate actions, various other things. Our stated aim is to target global share market-like returns, but to do so with that much lower risk profile than a traditional basket of shares. And then everyone always says to me, well, that sounds awesome, but how do you do that? Well, the way I like to kind of describe it is that we look to provide investors with two sources of returns. First, there's the returns that we generate from purchasing all those assets at a discount. So those assets will produce various returns, and that's the first kind of pool of returns that we get. And then secondly, we strap on top all of the returns that we make, unlocking the discount that we purchase those assets at. So just to break it down kind of granularly, we IPO'd 9 years ago at $1. We've annualized at just shy of 11% per annum after all fees and expenses. We're currently paying a grossed up yield of over 8%. And we've not had a down year in those 9 years, which we're very proud of. Touch wood. Sorry, touch wood. Anyway, so I was talking about how we get those returns. So the first source of returns, those assets, what you'll see here is we're only ever partly invested in listed shares. We'll then have a variety of other assets. So we'll have bonds, we'll have listed private equity, a huge kind of diversified pool of assets that we've purchased all around the world. And then by investing globally, we end up holding a basket of currencies. And again, the entire philosophy with the currencies is to drive down our risk by holding a kind of a pool of currencies that largely reflects the global investable universe. Now, the returns that we get from these two sources, so the assets there on the left-hand side and the currencies, they make up that first source of return. If I'm to describe it or if I was to put it out in graphical form, and I was to attribute out GVF's returns. So by attribute, I mean attribute out what we've made in the underlying assets, what we've made in the underlying currencies, and then show you what we've made in the discount capture. This is how it would look. This first wave here is the underlying assets that we've purchased all around the world. So we purchased these assets, very diversified, unique, conservative basket of assets, and this is roughly what they've done in the 9 years since we IPO'd. Then we've got the currencies, so that's the currencies that we've held through that same time. And as you can see, the combination of these two together has produced a low rate of return of around 6% per annum. And that's what we would expect. A hugely diversified portfolio of assets and currencies should produce a kind of a low rate of return. And that has produced that 6%. The way we have achieved the 10.8% after all fees and expenses is we've strapped on top the discounts that we've purchased those assets at, and we've released those discounts into this part of the chart, which is what we often refer to as the kind of the alpha of the strategy. Today, that's just a quick summary of GVF and how we get to do what we do. But today, I wanted just to spend a little bit of time talking about a theme that I've started to notice within the firm and that I wanted to share with you guys because, I mean, I don't know about you, but it does feel as though we have a plethora of bad news constantly heading our way, whether it's wars or the cost of living crisis. It's immense. And I wanted to kind of give you some positive feedback that I'm seeing within the team. As Miles said, we both run Stoudy Capital together, the manager of the fund. We run and own it together. And in particular, in the last 3 years, we've done quite well, and we've invested a huge amount of that into the business. We hired Mark Ambrose in March 2020. He has been a fantastic hire. He is essentially now the co-portfolio manager with Miles. He is based in London. The majority of our team is in London, and he's worked out very well. We've got a young analyst who also joined us in April last year. He is an Oxford graduate with a maths degree. He's also working out very well. And then together with James, so there's 4 investment managers in the team, which again is a lot of investment managers for the amount of assets that we run, but we like it that way, and that's how we find these really exciting and interesting trades. It's a very strong team, and I think that we're starting to see that in the returns and how things are panning out. On the operations side, we've hired Debbie Tanner, who is heading up the compliance and operations. We've invited Debbie Tanner and Mark Ambrose to join the Stoudy Capital board as well. So, you know, a lot of more diversification across the board. We've been working with a computer programmer for the last 2 years in the business, optimizing the systems within GVF and making sure that we can seamlessly work between London and Australia. Miles and I moved back in November last year. We've now set up an office in Australia, and that is allowing us, or will allow us, to focus more of our time on the Asian opportunities that we know are there, and that we've always we've done quite a few Asian trades in the past, but it is quite difficult to run campaigns from London and the Asian time zone. So from here, we'll spend a bit more time doing that. And I think for me, this investment into the business has done 2 things really. It's freed Miles and I up tremendously to focus on what I think we're quite good at. For you, you know, Miles has focused on the portfolio, spending more of his time and energy with the guys, going through the trades that we're looking at. And for me, it will allow me to focus more on strategy and spending time with our investors, which I'm very excited about. Secondly, and without wanting to tempt fate again, I do think it coincides with quite a good period of performance. And I just wanted to kind of prove my thesis by showing you a graph here. What I'm doing is I'm showing the last 3 financial years, so FY2, 21, 22, 23, and then FY24 to the end of September. And I'm charting, first of all, I'm charting global shares. So in Australian dollar terms, this is what global shares have done over that period. If you're looking for the bar chart for FY24, unfortunately, global shares are at 0 year to date. I've then charted global bonds. You'll remember, hopefully, from the pie chart earlier that in general, well, actually, consistently since our IPO, our 2 biggest exposures, if you like, to assets has been global shares and global bonds. And so I'm showing global bonds here. And then I'm showing just a picture of half and half, so half global shares, half global bonds. And then last but not least, I'm showing GVF and what we've managed to do over those time frames. 21, fantastic year for us. For us to outperform global shares with the lower risk profile that we run with was just really fantastic, and we were very chuffed with that. But funnily enough, we were almost as chuffed with 22, because when asset classes everywhere were down, and you can see major indices here being down that much is a sign of, small caps, the FANG stocks would be down so much more. GVF managed to produce a positive return, which we were very chuffed with. FY23, we saw another kind of return to 20% for global equities, 5% for global bonds. But again, GVF produced 15.5% in that year, which again, for the risk profile that we were running with, is something that we're very chuffed with. And then for FY24, look, who knows where we're going to end up, but we're off to a good start. And if I'm right about this theme of hitting our stride, I am feeling a little bit positive about what might come for us in FY24. So that was my theme today. I will have one more slide from me, and you guys would have seen this slide, but a lot of you would have seen this slide before. Miles and I always fight over the slide, so I've agreed.
He gets to present to it.
Exactly. I've agreed to put it in between the two of us talking, so he can say a few words too. But I just love this graph, because if there's one thing that you take away from the presentation today, I'm hoping it's this graph. It shows the profit or loss, profit on the left-hand side here, or losses on the right-hand side, of every single trade that GVF has ever done. It's worth clarifying that some of these bars are multiple trades in the same name, for example, in the same investment. And hopefully what it's showing is the skew that when we make money for investors, we make money. And when we lose money, which is inevitable with all investing, we don't tend to lose a huge amount. And that comes down to that margin of safety, the discounts that we buy these assets at. I'll let you take over from here.
Thank you. Emma, stealing all my talking points, which is just wonderful.
Did I?
Oh, no.
Oh,
I guess when I look at this chart, I would agree. If I could ask you all to take one image away from today, it would be this chart. Hopefully you can see two skews. So there's clearly a skew in terms of the winners are much greater than the losers, but also hopefully it's quite evident there's a much greater win-to-loss ratio than just flipping a coin. I think when it comes to investing, I think one of the mistakes that a lot of people make is they spend too much time focusing on investment returns and not enough time focusing on investment risk. And in the investment game, both of those things are equally important. You can't get away from that. I think one of the reasons we spend so much time focusing on investment returns is they're just much easier to understand. If I asked you how much your portfolio made last year, you could give me a very precise answer. If I asked you how much risk you had in your portfolio last year, that's a very cerebral kind of question that's hard to quantify. And just because it's hard to quantify doesn't mean it's any less important. There are some very funky mathematical formulas that do quantify risk that are not really fit for purpose and leave us all a bit befuddled. But I've always felt that this chart really summarises what we do at GVF, which is I'm very proud of the returns we've generated, but I'm just as proud of how well we've protected capital. And I always like to think it's a bit like skydiving. You always pack a reserve parachute. You can probably get away 99 times out of 100 without the reserve parachute, but that one day that things go wrong, you're going to be pretty happy that you had the backup in place. Hey, Jane.
Miles, just on risk, and I absolutely agree with you, it's underestimated as a driver of return, but can you just talk about a little bit about how you quantify risk or what measures you use to measure risk?
Yeah, so just because we're recording, so Jane's very sensible question was if I could give some insights into how we quantify risk at the Global Value Fund, how we measure it, and I think how we take it into the portfolio. I guess if I just I'll speak a bit freely.
Please.
When you're trying to manage risk, the theory 101 is the best place to start is with diversification. So what you want to own is as many different kind of asset classes that have as little correlation to each other as possible. And if you can find 10 investments that are all going to behave completely differently to each other, then you hopefully over way you've constructed your portfolio, you'll be able to survive with whatever the market does. If share markets go up, typically bond markets go down and vice versa. That's sort of the famous one in finance. Apart from constructing, we're sort of looking at risk in a portfolio sense in terms of how we can manage risk, keep it as low as possible while still keeping return expectations as high as possible. For what we do in our strategy, it's really the kind of the old-fashioned value investing. You know, Benjamin Graham, the father of value investing, his thesis was you buy things with a margin of safety. So if we're buying things cheap enough, then a lot has to go wrong for us to lose money. Obviously, we can have situations where things lose money, but if we're buying something that gets 70 cents on the dollar and that dollar's worth of assets falls by 30% and we still get out at NAV, we've weathered essentially a big fall in the market and not lost any money. And I find with this chart, the best way to explain that, really, that margin of safety, is to look at these ones in the middle. So everyone's eyes obviously gravitate to the winners, and then everyone's second thought is, well, what are the losers? But really the trades that haven't worked for us are these big gap here in the middle. So things that we bought that haven't worked out, but because we bought them on such a big margin of safety, it actually hasn't caused us a capital loss. It's more just we've tied capital up and not made any money on it, time value of money. That's risk and reward at GVF. In terms of, do you think I could ask you to click along?
Sure. I'm a clicking lady. I'll wheel around.
In terms of sort of the big picture and what I was hoping to say a few words on today, I wanted to say a few words on inflation, which is obviously enormously topical at the moment, and then to touch on one of my big pet peeves today. And then after that, I'll say a few words on the big picture, and to the extent that I can, try and offer some insights into what's going on with markets. But starting with that pet peeve, my view, I think one of the most dangerous narratives I see out there in the market today is this idea that, gosh, with the RBA lifting interest rates so much, I can finally get a decent rate of return by just parking my cash in a savings bank and not having to worry about investing and take all the risk with investing. And it's certainly true, you know, a term deposit today at a Commonwealth Bank or a NAB is going to pay you 4.2, 4.3%. At the start of last year, that same term deposit was paying 0.3 of 1%, barely above zero. So you've had a huge increase in interest rates in a very short period of time. What's dangerous about this line of logic, that cash has suddenly become an attractive investment class, is it, of course, ignores what's going on with inflation. Inflation is often referred to as the silent tax. Silent because we don't see it reaching into our pockets and grabbing our money the way we see governments do when they tax us directly. But just because we don't see it doesn't mean it's not there. It's a very real phenomenon. I've put up here the current CPI in Australia, the current inflation rate, and then a couple of the parts of the basket that affect all of us: housing, healthcare and food. And hopefully it's quite self-evident when you look at this chart that while it's seductive to have this idea that I can just put the money in the bank and not having to worry about investing it to preserve the value of my wealth, it's quite a precarious position to take. If you're putting money in the bank today, you're guaranteeing yourself a real-world loss of a couple of percent. And that's, in my view, not a particularly exciting option to do. And I think the seductive narrative that's tripping a lot of people up is just because the interest rates have gone higher, it might feel like you're earning a good rate of return, but in truth, nothing's really changed.
So you're saying when inflation was running at 2% and we were all getting paid zero on our bank accounts,
you were losing 2%.
We were losing 2%,
yep.
And now inflation's running at 6% and we're getting paid 4%, so we're still losing 2%. I get it.
So the equation hasn't changed at all. There's some interesting corollaries to that, and I think in terms of GVF, we're well aware that for us to generate the same returns that we've done historically, so if you look at Emma showed that we've annualized just under 11% in the past, we've done that in a very low inflation environment. For us to generate the same kind of growth in the real value of shareholders' wealth, we need to be doing better in the future. And we spend a lot of time thinking about that, and we're certainly well aware that that's our task now, is that future returns have to be better than our historical returns.
Oh, so this is a double good news day. Okay.
Well, if you ignore inflation, yes. And how do we get to those higher returns? Well, in theory, that first source of return that Emma was referring to before, the underlying market returns that we receive from the assets that we own around the world, that should be doing all the heavy lifting for us. Just, you know, economic theory, finance theory tells us that as interest rates go up, the the baseline expected return on all asset classes is supposed to increase in tandem. So if cash interest rates today are 4%, you should be getting an interest rate of 6 to 8% lending money to a company like BHP. A couple of years ago, we were only getting 2 to 4%. So you can see there's a big increase in what you get in your lending book. And in our debt holdings at GVF, you remember that was a big part of the GVF portfolio. It's been really pleasing to see places where we used to get interest rates of 2, 3, 4%, we're now getting interest rates of 7, 8, 9, 10%. And in some of the really interesting, slightly spicier parts of the portfolio, we're getting interest rates in the mid-teens. Really exciting. So we've seen a direct pull through of these much higher interest rates come into the returns we're getting from our lending book. It's important to understand here, however, what happens to those old bonds when interest rates go up a lot. So if I was saying today I can buy a bond from BHP that pays me an 8% coupon, BHP has old bonds on issue that pay a 3% coupon. Now, if I'm a bond investor, I'm a lot more excited about a bond that pays me 8% than I am about one that pays me 3%. So what happens in the market to keep parity is the old bond falls in price to a level where you get parity across the two instruments. So I can buy a new bond that pays me an 8% coupon, or I can buy an old bond that pays the old 3% interest rate, but I'm buying it at 90 cents on the dollar, and overall I get the same sort of interest rate. I spell that out because that's a very important dynamic in finance. As interest rates go up, the value of historical asset prices, in theory, is supposed to go down. And that principle is supposed to be what's happening in the share market and hasn't really yet. Once interest rates have gone up, asset prices fall, and it's from this new lower base that you get the higher expected returns coming through that you're supposed to get as part of how the whole framework holds together. Can we jump to the next one? Yeah. What concerns me, just thinking about the share market and trying to offer my 2 cents, what concerns me a lot today, and I know a lot of other kind of commentators in the market, is we haven't really had the big pullback in the share market that you would normally expect when you get a big increase in interest rates. We've had it in bond prices, like I just said before, but we're yet to see it in the share market. And hopefully these two charts give a little bit of an insight into that. The first chart on the left, you can see the navy line, that's US interest rates. And against that is an index of global corporate and government bonds. You can see as interest rates fell after COVID, bond prices went up. And then as interest rates started to go up again at the beginning of last year, bond prices fell almost in tandem. Those two charts are basically a mirror image of each other. It's that principle I'm talking about. As interest rates go up, the value of old bonds falls because they pay a lower interest rate than what you can get today. The second chart shows the same US interest rate, the navy line. And then against that, I've got the S&P index. And you can see that the principle started to happen. As interest rates started to go up at the beginning of last year, from there you saw the share market started to fall. However, it stopped falling about this time last year, raced around and reversed, and has been grinding higher ever since, despite interest rates going up and up and up. And that kind of goes counter to what finance theory should be saying is going on in a situation like this. If we rewind back to this time last year, it probably represented a bit of a peak in terms of market bearishness, as I was saying, for the share market. As I was saying, rising interest rates is normally bad for asset prices. And on top of that, there was this big consensus in the market that in trying to tackle inflation, central banks would lift interest rates a long way and it would end up putting the economy into a recession. And if you remember, about this time last year, a lot of the papers, a lot of the commentators were saying 2023 is going to be the year where the chickens come home to roost and we're going to finally have a big recession. You fast forward to today and that was completely wrong. So it just shows you the papers don't have much more insight than flipping a coin. Share markets are up 20% since then. It's been a tremendous rally. There's been two things that have driven this kind of share market move, which in theory is really defying gravity. The first one has been artificial intelligence. I'm sure a lot of you have seen all the kind of hoopla about AI coming along. And for the big cap tech stocks that are supposed to be the winners from this big AI, artificial intelligence theme, they've had a tremendous run in share price. There's been a huge amount of investor enthusiasm in the space. A lot of it is still to be tested. None of these companies are generating much revenue from AI yet. But those 6 sort of tech stocks have increased by about 50% on average over the last 12 months, which is an enormous move for big, large cap companies. And those 6 stocks on their own have carried the index higher. They make up about a third of all of share market returns over the last year, which is quite unusual on its own. And then the second thing that's dragged markets higher is that first point I was saying about we all thought there was going to be a recession this year. It hasn't come along. So the economy's doing better than everyone thought. There's been a bit of a sigh of relief, and companies are earning more money than people originally thought they would. Those two reasons on their own could be sufficient for share markets to defy kind of economic logic and keep going up. Shares are a very special asset class. So as well as being driven by interest rates, they're also driven by what people think earnings are going to do. Artificial intelligence could come along and create vast new earnings for the companies involved. Underline the word could. And a stronger economy today means all companies are earning a bit more money than we thought about. The flip side, I think, of the economy doing better and central banks not yet winning the war of inflation and economies like the US continuing to run really, really hot. And I think this is the sort of the flip side markets haven't really thought about too hard, is that interest rates are going to have to stay much higher for much longer and possibly go higher from here, because the game has not changed. We've still got to get inflation back to the levels that central banks want them to be. So that notion of interest rates staying higher for longer, I can see that playing out in a lot of other asset classes. I don't think it's been priced into the share market yet. I mean, one of the things about share markets that we all know is it's prone to kind of excessive optimism and excessive despair at different times. And I think that, well, look, there's an old joke. I put this in my letter to shareholders. This old joke that my dad always tells, which was the original dad joke. You know, if you want to make God laugh, you tell him your plans. This time last year, there was a lot of bearishness in the market. It was completely wrong. Markets have had a tremendous run. What I worry about a bit today is that there's possibly excessive optimism now, with people too excited about AI and the near-term kind of sugar boost of no recession this year, and not keeping their eye on the fact that it probably means there's a bigger recession next year, and that we will all have to pay the price for that. I don't know how it's going to pan out. I guess in terms of how we're positioning the GVF portfolio, we're very excited about the debt side of the business at the moment. We're seeing these big pickups in yields. It's coming straight through and should be increasing the returns we're delivering through to you. On the share market side, I guess we still own some share investments, but we're owning them with bigger margins of safety, and we're being a little bit more cautious. And I guess I don't quite have the confidence there that we're going to see this big pickup in expected returns that we're supposed to see from sort of finance theory. But the main takeaway, if I haven't lost you, and you should hold this to everyone, including ourselves, as interest rates go up, expected returns on all asset classes are supposed to go higher. I need to be standing up here and saying we should be doing better than we've done historically because inflation's higher, and all of your fund managers should be saying the same thing. Higher interest rates should mean higher returns across all types of investments. That's my attempt to look into the crystal ball for you. Then finally, this really interesting case study I was talking about. I think one of the things that I probably enjoy the most about my job is we get to invest in a wide variety of very unique kind of asset classes at the Global Value Fund. And as the portfolio manager, I'm constantly looking for places we can generate a good rate of return, but where we're not tied too heavily to whatever direction the market wind is going to be blowing. And one really interesting asset class we've done a lot of work on in the last year or so, and which is becoming a meaningful part of the GVF portfolio, you're all exposed to this today, is music royalties. It's quite of a strange asset class. So just to run through what it is, when you buy the music royalty, and I'm talking about pop songs that you hear on the radio all the time, you're buying from the artist the right to receive revenues whenever their pop songs are played or performed. And as well as receiving those royalties, there's the ability for the value of the catalogues you've bought to increase in value through time as the market gets bigger and bigger for songs. And that's one of the really important dynamics of the music world at the moment. Emma might be able to help run me through this chart at the bottom left. But sure. This shows US dollar millions of revenues generated in the music industry, so all the kind of the top hits you see. You can see the first wave there was vinyl. The second wave there was tapes, if you all remember recording things on tape.
Yes, recording the radio.
Recording the radio.
Remember trying to cut out the radio and trying to get the song.
Then in the 90s, you had this big boom of revenue from CDs, and then you had the counter fall as piracy came along and kind of decimated the music industry. And then more recently, the industry's really turned around, and the big driver of growth these days, and the market is growing enormously quickly, is from online streaming. So all the kids on their mobile phones, on apps like Spotify, Apple Play, Instagram, YouTube. There's been massive growth in demand for music. So the catalogue, the value of these catalogues is going up as you can sell your catalogue, your songs into a wider audience. For the artists that sell, people like Beyonce and Justin Bieber, it gives them the opportunity to monetize a lifetime's worth of earnings today. So you can sort of cash out, sell your portfolio for $200 million and sail off into the sunset and not have to worry about it. So on both sides of the equation are seeing a lot of value in this industry. And just to sort of run through what you're buying, so there's generally two things we can buy. The first is the master recording of a pop song. So whenever you play the radio, that's normally what you hear, a heavily produced, digital kind of pop song. And then the other thing you can own is the song itself, which is rarer. You think of the Beatles writing their own music, but is much more valuable. Whenever your song is covered or it's played in a commercial, you pick up revenues from that as well. As an investment proposition, music royalties has been around for a very long time, but it was a very niche asset class for most of the last 50 years. But in the last 5 to 10, a lot of new money's come into the space. The market's grown enormously. You've got a lot of big sort of private equity players in the space now, and a lot of artists are seeing the value of selling their portfolio. Like the big headline news at the moment is Queen. The big rock band Queen is reportedly trying to sell their portfolio of songs for $1 billion. So these are huge amounts of money, huge deals. As with anything kind of new and shiny in finance, people got overexcited to begin with. And the valuation of these assets got very stretched, and people were probably, in my view, overpaying for them. And during that time, two pure play music royalties businesses launched in London, and those were Hipgnosis Song and Roundhill. Now, as interest rates, sort of to fast forward through today, these names listed several years ago, to fast forward through to now, as interest rates started to go up last year, all that excitement turned into fear about what these assets are worth in a much higher interest rate environment. And those are legitimate fears. If you remember what I was saying before, as interest rates goes up, the value of anything that pays a fixed kind of coupon should fall down again. However, as often is the case with these things, at least in our view, you sort of went from overexcitement to excessive despair. And about 4 or 5 months ago, we were looking at these names and we could see that we thought these had been heavily oversold. Even under the most sort of distressed scenarios we were modelling, we could see a lot of value in both of them. So we bought a position in both the funds, and I wish I could say all of our investments worked this well. Within a few weeks of finishing buying our Roundhill investment, an industry player came in and offered a takeout price 60% above our share price. So tremendous win for us and a very easy exit for our investment in Roundhill. But I think the key thing for me and the team was that it demonstrated to us that all this work we've done, a huge amount of valuation work, had just been validated. If you have an industry player that's come in and is willing to buy the assets at a huge premium to the share price, that gives us a lot more confidence in our remaining investment in Hipgnosis Song. Of the two names, Hipgnosis is actually a much bigger company, so it's allowed us to get a much more meaningful position in GVF. And it also has this horrendously complicated, ugly corporate story going around it at the moment, which is perfect for us. We love deep value, messy situations where we can roll our sleeves up and start poking people and unlocking value. I won't go through the whole saga, but with shareholder consultation and with ourselves and others, 2 of the directors have just resigned from the board, the CFO's resigned from the board, the company's brought forward a whole new strategy to release value. So I'm hopeful that in the years ahead I can stand up here and tell you about how we've worked or we've seen value come out of our remaining music royalty business. But the thing that I love about it as an investment is as we sit there and work to get the value out that we see, we still think these assets are trading at nearly 50 cents on the dollar. We're earning a big coupon. We're getting a 6-7% yield while we're invested in these music businesses, and we think there's a lot of upside from there. And just to give you some final insights into what these businesses are, and to, pardon the pun, to show you some of the rock and roll. In terms of Hipgnosis Song, it really is. So this is the remaining investment we have in GVF. It's a big liquid company we've got a big position in. It really is quite a special portfolio. They've put together a very large, very diversified portfolio of music catalogues that cover some of the most famous, iconic songs and artists all around the world. GVF owns, or if you're a GVF shareholder, you own the rights to songs from bands like Nirvana, Red Hot Chili Peppers, John Bon Jovi, famous singer-songwriters, Ed Sheeran, Justin Bieber. The list kind of goes on. So these are not kind of one-hit wonders you never heard about. This is real sort of culturally significant music. GVF owns 13 of the 30 most played music film clips on YouTube of all time. So essentially, whenever you turn on the radio today, you're going to find yourself listening to a GVF song that you own pretty quickly. And when you do, you can perhaps have a chuckle knowing that in hearing that song, you're helping to pay for your own dividend check. And that was my little case study, and that was all I had prepared. So
I really like that example because I like the idea, you know, so often when these companies come to market and they get IPO'd, they often will come to the guys, they meet with the team, our 4 guys, and they'll get the whole IPO pitch, and the guys will, they never invest in IPOs, but we get a good sense of what the company is like, what they're doing, we get the initial pitch, we start writing up our notes, we start tracking the company. And what I love about this particular example is that we talk about that diversified underlying asset basket. And I mean, you can't really get any more diversified or uncorrelated than music royalties as something that we've purchased as an asset around the world and then added on top the discount capture part. So yeah, I think it's a good example.
Plus, it's a bit different. It's been a very fun investment, watching music videos and trying to value them.
And that's it from us. We have a couple of questions that were submitted, but I might open up to the floor first if anyone has any questions they want to ask. Please.
Yeah. That was intellectual property talking about that you've invested in.
Yeah, it's a copyright. It's essentially a type of copyright, yeah.
Why not some hard property like vinyl? It's going up.
Yeah, well, that's the revenues from, I mean, it's your vinyl's had kind of a comeback. Yeah. So I guess the key thing for us is we'll buy anything if we can buy it cheap enough. So we like this because it's an interesting asset class, but why we buy it is because we're buying it at 50 cents in the dollar. So we're buying these assets much, much cheaper than their fair value.
It's pretty hard to buy a record store.
It is,
Yeah.
I mean, and you got to worry about, you know, hit.
Yeah, it is. Well, some kids do.
Cheers. Did you have one?
I was just going to ask, where do you see yourselves in 10 or 20 years? Still going to be standing up there?
Yeah, definitely. If you'll have us. I mean, I think we've kind of gone through, as Emma said, we've gone through this big growth spurt. And I think we've got the team now where we want it. We don't need any more managers. We'd like GVF to be a little bit bigger. We've launched the second fund, which is sort of slowly growing to the size we want it to be at. But I'm determined to do this until you guys tell me to shove off. So we're not going anywhere in a hurry.
Yeah, I feel the same. I feel like we've built, it's been 9 years. I can hardly believe it, but it's been 9 years and we really love it. I really have a lot of satisfaction from this work, and I know Miles, he's really quite good at it. And I think he really enjoys it. And the team that we've got, we're not massive fans of, we're not going to build a huge empire. I'd be surprised if we hire maybe 1 or 2 more people in the team over the next 2 decades at most. We have a tight-knit team. We like working with the people that we work with. Miles and I get back to London quite frequently. We both go back at least every 3 months on alternate schedules. So that's also very important because, of course, we've spent so much time in London. I love that.
You did start off in
Yeah.
Of course, yeah.
And
yeah.
most of the
First,
team is still there. So
the whole, exactly. It's a London business, essentially. And we are working remotely for that London business, if you like. Exactly. And to bring our kids up in, let's be honest, possibly the best country in the world. So, yeah, for as long as you will have us. But under no illusions that if things change, you know, we understand and we'll move with that.
get into music.
Please.
Question about the music royalties. When you say, so for example, Ed Sheeran writes his own songs.
Yeah.
They own, when they sell that, they get it at a premium. But if they bought a song that's written by a third party, is that then shared between? How does that work?
Yeah, it's really interesting because a lot of music now is very manufactured. Like most of the pop songs you hear on the radio are not Ed Sheeran. You've got a team of guys writing lyrics, you've got a team of guys composing the music, then a production thing that goes all around it. So the rights, I don't have a clean answer for you other than to say each situation is different. But in that situation, the most valuable thing is normally the master recording. So they'll all come together, make one sort of iconic version of the song, and that's the thing that gets played on the radio or on Spotify.
where that royalty gets shared between however many people are involved in it.
Exactly, or unless someone like us comes along and buys it. And it's a really interesting industry, not to sort of geek out on it too much, but it's one where the buyers of these assets can actually add a lot of value. So when Hipgnosis Song buys a catalogue from Beyonce, the first thing they do is they've got their salesmen out there with sharp elbows and they're trying to make sure that her songs are in the next Revlon commercial or the next James Bond movie. So it's sort of a situation where a financial owner can sort of create more value
Amplify.
than the more valuable.
Took it from the top of the charts.
Exactly,
Yeah,
or used in
exactly.
like commercials and things, all that kind of
Or
stuff.
get
that-
some younger singer to cover it, you know, like
Yeah.
so many of the Elvis songs,
remix
for
or-
example,
yeah.
or covering those sorts of, so appealing to the next generation with older songs is a smart play.
And you know, Ed Sheeran is not going to chase Revlon to get the next kind of commercial deal, but a guy in a suit will happily do it.
It's their sort of marketing company.
I mean, in a way,
Yeah.
yeah, marketing company.
Does,
Yeah.
does the artist generally hold a percentage of himself, or do they normally sell 100%?
It's normally the whole thing, but there's everything's a little bit bespoke, and they're often these negotiations, as Hipgnosis would say, these negotiations are very sensitive. There's a lot of caveats around protecting the legacy of the work. Like Ed Sheeran doesn't want his songs played for like a nuclear bomb firm. I'm making it up, but you know, like for an arms manufacturer or something. So there's a lot of caveats around it. But in the realm of sensibleness, then we essentially own the rights. And it's a big payday for them. So I mean, someone like Justin Bieber recently sold his catalogue for I think 300 million, or a huge number. But it lets him kind of monetize everything now, not have to wait till he's 60, and he can, you know, start again and do something totally new. And invest his money in GVF, as he should be. Yeah, exactly.
I'm sure that's what he's doing.
They thought about doing the same thing like one artist, car sales, where they sort of never realise
Right.
anything till they're actually in the green.
Yeah.
Exactly.
Yeah, it'd be a bit like selling it to a museum, I guess, and the museum earns revenue from selling tickets. It's a similar sort of concept, but yeah. So I'll come back, Jake. Yeah, so I mean, just to sort of talk about the philosophy of that, we run with a relatively low-risk portfolio. We don't own a big basket of shares that bounce up and down, if you remember the chart. So against that sort of low-risk proposition, I'm generally happy to run a little bit of leverage that boosts the returns a little bit, and we aim to run at about 5 to 10% levered, and right now we're about 5%, which is where we normally sit. Yeah.
Invest in this kind of activity, you have to sell something off.
Yes, I mean, one of the features of the portfolio is we constantly have realizations and trading opportunities coming and going. But I mean, one of the things that I like to use leverage for, one of the advantages, and we'll probably get onto this, but LICs have had a bit of a beating in the press recently. One of the advantages of a LIC is that you can use leverage and you don't have to perfectly match buys and sells. So if we find something that's suddenly super cheap, there's been a big sell-off in the market, I don't have to go and sell something to free cash up to buy it. I can buy it, use a little bit of gearing, and then wait over the next month or two for an appropriate time to sell to match it off again. Yeah. Jane.
You mentioned you wouldn't mind growing the business a bit more. Would that, so for GVF, would that involve a raise of some sort, and also what would be your ideal size of business across both funds?
Yeah. So I think we were on record as saying we want to get GVF up to about 300, but no bigger. And we will only ever do that if GVF's trading at a premium. At the moment, we're at a bit of a discount, so a bit cheap. And we'd only do that if there's real demand. So if no one wants to give us more money, that's life, that's fine. But over 9 years, I think we've done 6 or 7 capital raisings when we've been at a premium. So if we were to get back to a premium, we've probably got 1 or 2 more capital raisings ahead of us before we get to the point where we say we're about the right size. We also have our second fund, which is going now, and is about 30 million US in it, or about 50 million Australian. And we don't really want that to get much more than 100. So we're well past kind of the halfway point of what we want to grow to as a business. And as Emma was saying, we kind of invested in the management of that first. So we've got a big, heavy team, and hopefully we can grow AUM a little bit to sort of match that over the next few years. But we're in no rush. We'll just get there when we get there.
Just another question. So you mentioned also the LIC structures being on
Yeah.
And we've just seen Jeff Wilson, for the first time, I think, offer
Yeah.
different structure. So I'm just interested in your thoughts on LIC, the sector generally.
Yeah.
Actually, that was a question as well from David Elliott. He said the exact same thing as you, Jane. You know.
Well, let me repeat the question just for the mic. But
Okay.
so the question, to paraphrase, the LIC sector in Australia has been under a lot of pressure recently, and then we've seen Jeff Wilson, kind of the grandfather of LICs in Australia, launch an open-ended
I don't know if
fund.
you'd like grandfather.
Okay, well,
Let's
or
go with
the
father.
mentor, or launch an open-ended fund, which he's never done before. You know, does this all ring the bell for the end of LICs? That's probably a fair synopsis. Well, to start with Jeff first, we know the guys at WAM really, really well. And if I rewind back to 5 years ago, when they brought WAM leaders to the market, I'll be honest, I and a lot of people were quite sceptical. Like, it's hard to outperform big cap stocks in Australia by stock picking. Most of the research says it's basically impossible. Fast forward to today, and Matthew Haupt has done a tremendous job there. It's been a tremendous success, and they've raised a lot of money into that strategy. And I think, and you should ask Jeff these questions, I'm just kind of giving my observations, but my understanding is that it's unusually for the kind of things that interesting fund managers do, it's a very scalable strategy. Like in our strategy, we could never run billions of dollars doing what we do. But in large cap ASX stocks, you literally could run billions and billions of dollars. So I think from them, it's just a business point of view. There's lots of potential investors out there that don't want to invest in LICs for a whole host of reasons, often because they want to put much bigger amounts of money to work. If you're an institution and you want to put $50 million with Matthew Haupt, you can't really buy and sell that on the ASX. So my understanding is not that Jeff's given up on LICs, it's just that he's got a product that's doing really well and he's trying to open it up to a different investor base. But you should definitely ask Jeff that, not me. And in terms of LICs in general, it's fascinating to watch, and it's actually part of our business model. These structures come and go out of favour all around the world all of the time. I was saying earlier before, the very first closed-end fund was set up in the 1800s. So these things have been around for 200 plus years, and they were set up to fund the development of the US railways. You remember that whole story of British money going in, building the railways in the US? A lot of them blew up, some of them succeeded. And as a structure, it's constantly reinvented itself, and it's gone through bursts of hyper excitement and big despair. If I look here in Australia, I think there was a big wave of new LICs that came to market 4 or 5 years ago. And unfortunately, without kind of, throwing shade at any competitors or anything like that, I'd say a good portion of them didn't live up to what they said they'd do on the tin. And because of that, they've traded at discount. So I think part of the discount problem we're seeing at the moment is not so much people giving up on LICs, it's just that there's a number of managers where they haven't performed the way that they promised shareholders they would, and performance is what generates the best rating over time.
It's also possible that the raisings were too big.
And there's possibly a case of rationalisation where too much money came in, and just like I showed with the Roundhill example, where people get too despondent the other side of the equation.
And at the end of the day, a discount is there because there are more sellers than buyers.
Yeah.
So I think it could be a combination of that as well, and it's natural in the cycle for that to kind of balance out.
Yeah, but if you look at some of the LICs like PM Capital, PGF, they've done a tremendous job recently trading at a premium. I'd like to think we've done a pretty good job over a long period of time. We've never had a big discount problem. So I think the places where you're seeing the discount problems, it's perhaps not so much a LIC problem as it is the product is just not doing what it promised it would do. And then separately, that you have a big period of probably too much money raised. You need to have a rationalisation period, and the number of options shrink. Hopefully the ratings get a bit better. For us, it's wonderful. We invest in discounted LICs. That's basically our business. So we've had a field day here in Australia recently. One of our biggest investments, which we're on public record as saying, is in Magellan, MGF. And some of you might have seen that yesterday they announced that they were going to convert that into an ETF. So that was the biggest investment in GVF. We owned it at a wider than a 20 discount, and we're going to get out at parity sometime next year. It's been a tremendous investment.
And again, tremendous investment because the underlying there were large US
listed
stocks
that have participated in the rally that I was just talking about.
Yeah.
There's a number of other names we're very actively involved in, but we're not public about it, so I won't talk about it. But I would say it's far too soon to give up on LICs. And even in an Australian setting, you look at things like AFIC and Argo. They have been through dozens of cycles in their 60, 70-year history. So we'll watch this space, but I think it's a bit early to say it's the end of the day for them. Yeah, g'day.
Sort of a strange question, perhaps, but
I know you're worried about inflation.
Yeah.
Do you think that inflation, when we get back to anything of 2 to 3%?
Yeah.
Now, I'll give you an example of why I don't think it's. My first ever investment was a house in Brisbane, right? A friend and I bought it for $60,000.
Wow.
We were getting 9%.
On,
Gross.
as a rental yield.
Now I'm talking about in 1980 something.
Yeah. Wow.
But the return on a house at that time was about 9%.
Yeah.
These days, people are going out and buying houses and accepting yields of gross 3-4%.
When inflation's at 6. Yeah.
Now, isn't perhaps the inflation we're seeing is a return to the median
Yeah.
rather than inflation?
Yeah. It's like the key issue in finance at the moment. So the question from the gentleman was, how do we see inflation panning out in the future? Is higher inflation today perhaps just a return to the median or much higher inflation in times gone by? It's an impossible question to answer, but it's a really fascinating question, and the answer will drive what markets do over the next sort of decade. I guess on one side of the argument you have, we've just been through this period where China got integrated into the global economy, Eastern Europe got integrated into the global economy. You've had a big boom in global trade, and it's suppressed prices of things for a long period of time. The argument that inflation is not going to go away is that the China phenomenon is now going to reverse. You've got a much older workforce everywhere today, so you've got less workers producing the same amount of food or things to buy. And you can make a case that inflation needs to be structurally higher. The problem is people have been making that argument for the last 10 years, and pre-COVID it was tremendously wrong. So I don't know how it's going to pan out, but I guess what I think and how we sort of position the portfolio a little bit is there's so much credibility on the line for central banks to get inflation back down. I think they will keep going at the expense of pushing us into recession, which is the thing that worries me a bit. And I also think that getting inflation down from, say, the last percent or so, getting it from 3 down to 2 is going to be the really hard work. I think getting it down from the high figures down to sort of 3, 4 is going to be much easier than squeezing it from 3 to 2. And unless they give up on their commitment to that number, I do think we're going to have some economic pain. Like, they can't let inflation keep rolling along like it is. But if I knew the answer, we'd be doing very well.
We had another question from one of our shareholders, and it was around the discount that GVS is currently trading at. And I thought I might just talk a little bit to that. So GVF, since our IPO in 2014, 9 years ago, the average discount premium that we've traded at on a monthly average basis has been around 2% discount. So we've always traded very close to the NTA. At the moment, we're trading at about a 6-7% discount. And there's two reasons we think for that. The first is we have a large shareholder who has to sell quite a bit of the shares and has been sitting in the screen, getting that out slowly. So that's the first thing. And then the second thing, and this is something that Miles and I feel so strongly about, we definitely think that there's a very strong correlation between us marketing. So what we've seen historically over the last 9 years is when we go on the road and see investors, we tend to see our share price go to a premium at the end of our road shows, and then it kind of holds us for the whole year that we're still in London, and then we come back around a year later and it's at a small discount again, and we hopefully push it back into that positive space. With having our third child, we haven't been marketing for more than a year and a half, and we've just seen that discount kind of creep in. But we are, working on getting it out and getting us back up to
We're
that.
back on the old schedule now. So,
Exactly.
And hopefully a better schedule. Part of the reason
Yeah.
for coming back to Australia was instead of trying to do one mad marketing trip every year, we can do a lot more. We can see a lot more people.
Yeah.
We've had to turn down in the past all these wonderful invitations to speak at ASA events and things like that,
Yeah.
just because the time zone makes it impossible to meet people out here.
Exactly. So hopefully we're going to spend a lot more time doing that, and we've had a really kind of positive reaction in this roadshow. I think we're a week in, so I got another 3 weeks to go, 3 or 4 weeks to go. But yeah, I just wanted to address that because if you do see us, at the moment we are trading at about a 6-7 discount, and that's quite rare for us.
As Jeff Wilson would say, bargain. Bargain.
A bargain. That's true.
G'day.
I know how to get a pretty good discount.
Oh, yeah?
Tell me.
Just keep raising the dividends.
Yeah, I know.
Yes. Well, we could actually.
Well, do you mind jumping back to the
Yeah, sure.
to the chessboard slide? So on the dividends, we have this kind of discussion at a board level a lot, and there's clearly a lot of shareholders that want the dividend to be as high as possible. I guess the things that go into this dividend discussion are we've generated returns of nearly 11% per annum, and we pay out about 8%. So we're paying out about 80% of what we make. There's still probably a minority, but not a tiny minority. There's a reasonable cohort of shareholders that say they would like us to pay a lower dividend because they'd like the share price to go up. So we can't do both. If we generate 10% return, we can either hang on to it, which will increase the NTA, which should increase the share price, or we can pay it all out. And there is a sort of nuance, theoretically you pay a slightly lower tax rate on capital gains than you do on dividend income. So those are the things that go into the equation. I guess what I try and say to people is that paying out 80+% of what we earn, we're definitely in the camp of we're going to pay most of it out. But it's not an easy decision to make. All I can do is focus on the return number, and then we can sort of carve
Divvy
up the
up
pie
that.
as we do. But
Fully franked.
yeah.
Don't ever lose that.
Yeah, we're doing our best.
What?
Yeah,
I live on it.
I know.
No,
So many
I
people
know,
do. We know
I
how
know.
important it is.
But we are an international company, and we are investing internationally. So we don't get franking from our investments. But obviously, Miles will just keep doing positive investment returns, and we'll just keep paying the ATO tax to get franking. So it's no problem.
I've been since the IPO.
Have you? Wonderful.
Yes, I know.
Stop.
Thank you.
If it ever comes to that, and we have partially franked dividends in the past, as you'll know, we'll just increase the dividend to make up for it, the cash dividend.
You should say the board will increase the
The
dividend.
board, not me. I mean, I have no say, but the board, yes. As you can see, our directors there on the screen. Perfect. Does anyone
call
have
it a
any
wrap?
questions, or should we go and have?
We're here, obviously, but I think we get some cake and stuff. Yeah.
Your other fund you've started,
Yeah.
what is it and how's it performing
Yeah.
compared to global?
Oh yeah,
Yeah,
great question.
great question, actually. So, I mean, and just to talk a little bit about that. So, we wanted to launch a second product for institutions. So, again, like I was talking about with Matthew Halp, it's hard for large institutions to put a lot of money into GVF. There's just not the liquidity. And at my previous firm was a hedge fund in London. We used to manage money for sort of large endowment funds around the world. So, we set up a structure for those types of investors. Unfortunately, it's not a very user-friendly structure for retail investors in Australia. It's a Cayman Island structure. It's denominated in US dollars. The minimum investment is $2 million. So it's for wholesale, and legally we can only take wholesale investors into it. But apart from that, it's very similar to GVF. Its returns have been quite good since we've launched. We're really proud of that, touch wood. It has a
So much
slight,
work.
so it shares all the same investments. It's a smaller fund. And it has a slightly higher risk and reward kind of profile because the institutions have longer investment horizons. Some of these institutions are investing for the next sort of 20, 30, 50 years, whereas I think a lot of people in GVF are in retirement phase, they sort of got half an eye on, can't suffer a big drawdown in the near term. So in the new fund, we use a little bit more leverage. We sort of push the boat out, not enormously, but a bit more. And hopefully over time that should mean slightly higher returns than GVF, but a more bouncy ride along the way.
It's identical to GVF except for, so same fees, same everything, except for it's US dollar denominated, 2 million minimum, and doesn't pay anything out. So it's a massive accumulation. Yeah, it doesn't pay any dividends or anything like that. It's those institutions. They don't really want them, no, especially the longer term investors. Exactly. Exactly. So we wanted to kind of diversify Starter Capital a little bit and just have two types.
GBS invested, we as shareholders of GBS actually invested in that.
Oh, no. They're both, so...
They're both separate funds? No.
No, we can't invest in each other's funds.
No.
So
No.
when we buy $100 worth of Hypnosis Song, we'll probably put 80 in GVF because it's a bigger fund, and we'll put 20 in the
It's
new
all
fund.
pro-rated on a pro-rata basis, yeah.
Yeah.
So yeah, it's
Touch wood, it seems to be going okay. Cool. Well, we're still here, guys. I think there's some
Yes,
we have
we've
some
got
drinks and
some-
tea, so we can keep
some
chatting
snacks,
outside if you like.
hopefully.
And thank you very much. Thanks
Thank
for coming
you.
along. Really appreciate
Thanks,
it.
guys.
Thank you.